Hi, and welcome to this week's Mindset Podcast. I am here with Shannon Robnett, who is the founder of Shannon Robnett Industries. Shannon, thank you for joining us today.
Good. I'm doing very well. How are you doing, Daniel?
I'm doing well. I'm doing well. Thank you for joining us. I'm looking forward to spending time with you, especially because of the 25 plus years of experience that you've had in the construction projects such as single family properties, multifamily professional offices, as well as you've done some city work such as city halls, police stations, and fire stations and schools. So. Looking forward to seeing your unique perspective on the real estate investing sector and kind of conversation around that.
Well, yeah, I grew up in an investment or in a development family. My dad was a builder and a developer, and my mother was a real estate agent, and so I always saw things going on. And when I started my company back in 1999, I saw that I had the opportunity to either work for other people and create their dreams, or I could begin the investing in the development journey as well. And so I began to not only build and develop for other people, but I began to do projects on the level for my own personal portfolio. And I watched my parents retire when they were 50 years old with cash flow, and I knew that that was where I wanted to get. Along that course, I've done everything from, like you said, medical office to city halls to fire stations, police stations. And it's been a heck of a journey, one that's always full of the ever-changing real estate market that we see that again, everybody's talking about a new market, but it's just changing back to the market that I know.
So I'm glad you brought that up because market trends is always a topic point that people have their opinion on, right? And in this market, where the interest rates are through the roof and the property prices have gone up, 10, 15, 20% in some markets over the course of the last 3 years, it always brings up the question, is now the time to invest?
Well, the reality is, our investment thesis has always been to buy good assets in great markets, right? Because I would rather have a good asset in a great market than a great asset in a good market. Because when you have the whole market moving, right? Let's take North Carolina or Dallas or Phoenix. Those markets are very, very strong economies on their own. So when you run into things like a recession or COVID or things like that, those markets are still going to outperform markets like San Francisco, New York, and things like that. So we look at strong markets first, and then we look at strong asset classes. Everybody is complaining right now that rents are getting soft on multifamily. That may be true, but we're still somewhere between 4 and 9 million housing units short in America. So the asset class as a whole, when you look at long-term, is still going to continue to remain strong. Another asset class that we really like is industrial, because industrial, we've got a growing economy right now. And when we go into recessions, that is the single greatest time in history that new businesses are created in the United States, and has historically been that way. So when we look at that and go, well, there's a recession coming, that means there's a lot of new businesses that are going to be started.
Yeah.
And so we look at that and we do our underwriting based on a 5 to 7 year window. And we have always looked at interest rates being historically where they're at. So interest rates have gone through the roof from the floor, but it doesn't mean they're through the 5th floor or the 6th floor like in the 70s, right?
Right.
And so when I look at that, I always make sure that the deal pencils from the beginning, and you're locking in your interest rate. And if you can make a deal work at 8% and the rents that you're getting, why wouldn't you do it? If you need 5% interest to make the deal work, well, the problem is that the seller's price is too high, right? And that just means that that's not an asset you're going to purchase, because nobody likes to arbitrage money and lose money, right?
Right.
So the reality is taking that and just working through your spreadsheet and understanding that you're underwriting. You cannot get every deal to work, but if you underwrite correctly, you can make a good deal work just fine in today's environment.
So if I'm an investor and I'm looking to find a great market, how do I identify a great market versus a good market to know that's where I want to invest my time in? Because a lot of investors, their biggest issue is, well, where do I start? Where do I find a market that I can start to buy property? So what are you looking for when you're defining a great versus a good market?
Well, Daniel, you have a very common question. In fact, so much so that we've created a series that we dive into markets and we take them apart piece by piece. We've done that on Phoenix. We've done that on Houston. We've done that on Raleigh, North Carolina, Nashville, Tennessee. I think before this airs, we'll have done San Antonio, Texas. And the top things that we look for are job growth. We look for wage growth, right? So when I look at Houston, Houston has a household income of about $58,000 a year.
Mm-hmm.
Okay. That's not a great market for new apartment developments,
Construction, right?
because 1/3 of that rent is not what I need to make a new apartment development pencil. But it is a great market for industrial because $58,000 a year is a blue collar job, right? And so when I look at that, I look at how strong is the economy? Is it growing? How strong is the job growth? Is the number of jobs growing? Is the wage growing? And Houston has fairly strong wage growth. It's just a little bit behind somewhere like Raleigh, North Carolina. Raleigh, North Carolina has an amazing job growth economy going on right now. It has also percentage-wise, it's growing very strong. It's very strong in the tech and the biomedical centers. And those are things that are traditionally not hindered by recession, right? If you're dealing with an economic slowdown, everybody still needs healthcare, whether they're broke or whether they're rich, whether they're making more money this year than last year, they still have, to see their doctors and they still need to get treatment. And so when I look at that, I look at a diverse economy. I look at the age of the economy, right? Raleigh, North Carolina has an average age of, I think, 38 years old. That's young, right?
Right.
That means we got a lot of people working there. And then I look at the percentage of people that live in that economy, that work in that economy. So I like to look at those. I like to look at the politics of the economy. And I don't mean how many Democrats there are and how many Republicans there are, because I don't want to start any fights on your show, right?
Fair enough.
But,
I appreciate that.
What I look at is the area landlord friendly? Do they make it the eviction process fairly easy?
Right.
Do they make it so that I can raise rents, or are they into rent control, right? Mm-hmm. Those are the kind of things that I look at, because the last thing I want to do is invest my money in a state or in a city that says, no, you can't raise rents because we have rent control. No, you can't kick them out because we have given them all the rights, right? I paid all the money. I pay the taxes. I want to be able to do with my property what I need to do to run a business. And so when I look at all of those and put those in my matrix, I can see that by comparison, this is a very strong economy. And I think if you look, California, their biggest export, it used to be strawberries. Now it's people, right?
They're all exiting and going to either Texas or Arizona
right.
One of those states.
And so now all of a sudden, California is starting to repeal some of the laws that have people leaving. So again, that's politics. California is starting to wake up as to the effect of the homeless population in their city on the businesses in the city. So you look at these kinds of things, and when you see that and you look at how that politically fits in with what you're trying to do, then you're able to make better decisions. And now, instead of looking at it and go, gosh, I have an investment opportunity in Kalamazoo. I've got one in Klamath Falls. And since we're going to stick with the Ks, I can go to Kansas City, right? But you don't know how those economies compare. And so the first thing that I do is I dial in and I determine what is the good market. Mm-hmm. I know that I really like Houston for industrial. So now everything industrial that comes through on Houston, I'm going to take a look at. And I'm focused on that area. We've got a deal going in Nashville, Tennessee. I've explored that market. I know that market, and I love Nashville for multifamily. So now when I'm looking at that market, I'm not looking at industrial necessarily in Nashville, but I'm also not looking at Kansas City. I'm focused on Nashville, right? So, they say a confused mind does nothing, right? Mm-hmm. But if you know that I'm only looking at these three markets, then you know exactly where you're looking, and you're not looking at 100 deals, you're looking at 10 deals in three markets, and it makes it much easier to make a decision.
So what you're saying is, so we talked about the 5 to 7 year kind of the expectancy of when you talk about that's what you're looking for before purchasing a property. That's based off the growth of the economy, jobs, wages, as well as the politics. Again, We're not talking about Republican or Democrat, but we're talking about how easy is the state better for me as a landlord or for the renter, right? Employee versus employer kind of conversation. How important is it to become an expert at either industrial or residential? Or do you say learn both at the same time, find the markets and understand the markets more important than, no, let me spend 2, 3, 4, 5 years building my portfolio as a residential investor, and then let me grow into industrial, and then from there, let me connect with someone like Shannon once I've built my residential portfolio, because that's a different beast.
Well, the thing about industrial is actually easier to do than multifamily. And I'll explain why.
Interesting.
First of all, industrial leases are triple net leases. And what that means is that all of the operating expenses of the building are the responsibility of the tenant. So when you look at a multifamily deal, you're going to charge $1,200 for rent. That's it. You might get a bill back for the rubs, for the utilities, right? But that's it. You're not going to really get anything else. From there, you've got to convince the tenant that maybe they want to pay for internet, or maybe they want to pay for additional bike storage or rent another parking spot. You've got to try and upsell them. And the tenant is only going to commit to give you 1 year. And at the end of the year, they can leave if they want to or anything like that.
Right.
When you look at an industrial project, the rent that you're quoting is without expenses. So you're going to quote the rent and you're going to say, my rent is $1,200 plus triple nets. That means that the property taxes, the insurance, the lawn care, the management, the roof repair, the HVAC unit inside the building, all of those things are the responsibility of the tenant. So when insurance goes through the roof, I just take the bill and I hand it to the tenant, right? I process it, I pay it so that I make sure it gets paid, but that's a responsibility of the tenant. So at the end of the year, if I said the expenses on the building were going to be $500 and they were $700, I show that to the tenant. I ask the tenant to pay me the additional $200, and I set next year's expectation at $800. And so now he is paying me an estimated $800 based on a pro rata monthly basis. And so it takes a lot of the guesswork out of it. It takes a lot of the brain damage out of it. It takes a lot of the problems that people run into in multifamily of how do I underwrite this? Because I have to understand exactly what the property taxes are and exactly what my repairs are going to be and exactly what my maintenance is going to be. And then in order to be a good operator, I have to squeeze those as much as possible and run that delicate line of not putting in enough maintenance and repairs that all my tenants leave. And yet I still want to be profitable. So I got to minimize my maintenance and repairs. All of that gets taken away in an industrial project. You also combine that with the fact that most industrial leases are 3 to 5 to 10 years long. They have built-in rent adjustment riders. So you know that if you buy a building today and it's the beginning of a 10-year lease and they're going to take a 3% rent bump annually, you know that you're going to be collecting 30% more rent in 10 years. It's really, really easy. The problem with the industrial is that a lot of people are, I don't want to say afraid of it, but they're intimidated by it, because when people think of industrial, they think of an old junky metal building surrounded by, half of a car and an old dog shed and everything right down by the railroad tracks, right? But, we look at newer industrial product. We develop a lot of industrial product, and we have everybody from cabinet guys to fire alarm sprinkler companies to window tinters. We have a guy that sells golf carts. We've got a guy that makes gelato ice cream. I like going and visiting him.
I wouldn't blame you. I'm sure you get some benefits from being the landlord of a gelato ice cream shop.
So, but a lot of people look at industrial from a very different lens because they misunderstand it.
Well, I mean, it's very intimidating. I mean, again, I'm new to investing, and personally, I've done, I've got my own investment properties, but if you come to me and say, hey, Danny, I have an industrial opportunity, right? You, Shannon, being someone who's been in this business, come to me and say, hey, I've got an investment opportunity, and it's in the industrial space. I'm going to turn around and look at you and go, what do you expect from me? Because, I mean, for me to kind of come in and say, all right, I'll take that leap of faith without knowing anything about industrial investing is pretty scary. Right. And I think that's kind of where the intimidation factor comes into play. Like you just, we spent a couple of minutes talking and you've talked about some strategies that I've never even heard of, let alone, or haven't even looked into, let alone heard of. So how do I, as someone who's maybe been in the investment space, turn around and say, okay, now it's time to me to take a little bit larger of a leap of faith and find someone like Shannon that I can start to, get into the larger investments rather than the residential?
Well, and Daniel, I like to I stole this phrase from a friend of mine, but it's about being important to important people, right? And
Okay.
so there's a lot of people like myself that are doing investing in the industrial space and finding ways to connect with them, finding ways to find their information, see what they're doing, helping them out so that you can gain more information. But also Elon Musk, he said something that I truly believe. Everything you want to know is on the internet, and you can get a college degree on YouTube. And so I think that if someone really wants to understand it, there's a lot of opportunities for that. The other thing that is very easy to find is information on markets from the large industrial brokers. So Colliers International, Cushman and Wakefield, all of the large brands have industrial indicators and industrial market research on their websites. And so you can go in there and you can find out how much industrial was leased this quarter versus last quarter. Are rents up? Are rents down? And then just begin to get the education of what to do, because it's really not hard, and it takes a little bit. But I think that when you think about it, we bought a $6 million asset in Houston. It came with 8 tenants. Now, when was the last time you bought a $6 million asset that only had 8 tenants?
Never.
Right?
Right.
And so when you think about deployment of capital and interface with the other side, or the tenant aspect of it, there's nothing simpler than industrial. And when you really take and peel the onion back, you'll realize that it's far less complicated and intimidating. But we all know that. We just inherently, it doesn't process with us. But when you look at it, the majority of REITs are in the industrial space, not in the multifamily space. And we look at how much froth has been brought to the multifamily space. And it's because there's a lot of retail style investors in the industrial space, and a lot of that was trading on emotion. The final point I'll make to you about industrial is industrial always trades at about a 1.5 to 2 cap higher, which means more cash flow than multifamily, and has historically for years.
Interesting. You talked about property taxes quite a bit, and I know that is one of the strategies that you have, right? You've talked about layering strategies. And by the way, there's a quote that I love from you: a more intelligent investor creates a better investment market. And I think that is such a profound quote, because a lot of investors who get into the game initially don't take the time to advance their strategies to find ways to maybe get more tax benefits, or talk about depreciation, or we've talked about preferred zoning. What are some of the strategies that advanced investors can use to maybe take their investment portfolio and really take it to the next level?
Well, I think you touched on it. Taxes are the single largest expense in everyone's life, right? They say that the average Californian, by the time they make their paycheck and spend their money, is about 61% of their paycheck goes to taxes.
In California, it's a totally different beast. Yeah.
Right. And I like to use the Republic of California as most of my examples, right? It's a very good case study on what not to do. But, the reality is it is the single largest expense in your life. And so if you will take and look at the tax code, not as a penal code, not as something that's designed to punish you, but as something that's designed to help you understand what the government needs your partnership to do, right? The government cannot build buildings. They don't build multifamily. They don't build industrial. They don't build railroads, but they offer tax credits to those that do. And so since I was young, I began to adopt that philosophy, and I've always looked at it and gone, what's the tax side of this deal? And I got to be honest with you, Daniel, I think the first thing I think about when I look at a deal is not the price. It's not the monthly payment. It's what does this thing do for my tax bill? Because even on the federal side, if you're making over $250,000 a year, you're paying over 37% to the federal government. Now, if all you did, Daniel, was eliminate that tax bill, you would have 37% more to invest, which means that you would not grow your assets 37% faster, but it would be a compounding 37%.
37%. Right.
So instead of investing 100,000 in year one, you would invest 137,000.
Right.
That would then become what,
250
145 or
versus, right,
something.
right.
And then you would invest another 137,000 with that, and it would really compound. And so we look at things through the tax lens more than anything. We have a particular project that we're doing right now. We bought an industrial project that was the rents were about half market, but it was one block from the mall. And it's also about 6 blocks from the main bus terminal. And we got that property rezoned for 200 units of apartments, right?
Wow.
So now we bought the property. We did the bonus depreciation, right? We brought in about, I don't know, $2.5–3 million of investor capital. We took the bonus depreciation. It gave the investors back about $1.6 million in tax benefit, right? But here's the thing. It's in an opportunity zone. So everybody showed up with capital gains taxes that they were looking to defer. So an opportunity zone requires you to pay that tax bill in 2026. But it also says if you own the property for more than 10 years, when you sell it, you come out of the property tax free.
Wow.
So they brought in their tax gains. We gave them $1.6 million in tax benefit. So they got half of their tax bill paid in the first year. And next year, we're going to tear down the building. So we're going to complete the bonus depreciation because now we have no building. So now we're going to take another $3.5 million in tax benefit. So now they've received $4.5 million in tax benefit on their $2.5 million investment. And now we're going to build a building there that's going to have 200 apartments in it. We're going to hold that property for 10 years. And when we exit,
we have no tax, zero
we
tax.
have no capital gains. So now what we did was we took what was a 20% tax, we got rid of that. And when we exit, we're going to exit without that same 20% tax. So in essence, we're going to grow their money like it's in an IRA and grow tax deferred. And then when we get to the exit point, we'll exit tax free. So by just thinking about that, it doesn't make a bad investment good, but it makes a good investment better.
Great. Yeah. Wow. I mean, within the 25 plus years, because it's closer to 27, it's not 28 years that you've been in this industry now, what are some of the learning experiences that you have that you can maybe share that have allowed you to take what would have been maybe a bad investment or a bad deal that turned it into a deal that allowed you to profit or learn from, so that in future deals you actually, again, you learn from this?
Well, Daniel, one of the other things I like to say is I've actually made $1 off of every mistake. And the reality is that every mistake I've made has taught me a lesson that I have learned and worked very hard not to repeat in the future. And so when I look at real estate, the biggest thing I could tell people is that time is your friend. Time, if you look at the bottom of the market or let's say the absolute peak of the market in 2007, if you would have bought the day before the market crashed in 2007, and you would have held on to that asset now, you would definitely have made money. If you would have bought at the bottom of the market, see, everybody tries to time the market. You can't do that. You make a good investment based on all the parameters that are here today. You lock up that money. You lock up that tenant, you do the things that are necessary to create and actuate the business plan, and then you hold on. And time will always, always work for you. If this year is not a good year to sell your real estate, don't sell it. If 10 years from now, the market is super red hot and you want to sell it, sell it. But what I find to be the biggest mistake that people are making now, and one that I have made in the past, is trying to say, I'm going to buy this property. I'm going to do these 3 things to it in the next 12 months, and then I'm going to sell it for a profit. This isn't taking matchsticks and gluing them together and selling them as trinkets, right? This is a long-term thing. So always think about a 5 to 7 year window when you're making investments, and you likely will not be disappointed.
So if I take a hit, let's say 2 years in, where I've got a property, I bought it for 500, and let's say it's dropped down to 490, 480. What you're saying is, don't worry about it.
Right. Let's just say you bought it at 500, it dropped to 250. The only time you realize those gains is when you sell. So the fact that it appraised for 250, the bank's not going to bother you about that. Are you still making the payment? Yeah. Is the tenant still in there paying the rent? Yeah. Did it cash flow at 500? Yeah. Does it still cash flow when it's only worth 250? Yeah. Does it look yucky on your balance sheet? Yeah. But it will come back, right? But what people do is they trade real estate like it's stocks, thinking, well, I'm going to sell this one in Kansas City and I'm going to take my $20,000 loss and I'm going to go over here and I'm going to find a different market. Don't do that. Just leave it alone in Kansas City. It will come back. Maybe your kids are going to sell it. But in the meantime, it's still cash flowing. It's still doing something for you. It's still providing tax benefits. So don't get in a hurry just because the value of the houses around it or the value of everything else is down, because this is there are multiple facets to real estate that you don't necessarily usually have in a stock. When you buy and sell Tesla, all you're doing is buying and selling the stock. So you want to buy low and sell high. For whatever reason, I seem to have that in reverse, and I always buy at the wrong time. That's why I don't do stocks, right?
That's a good thing you're in the real estate space.
Yeah.
Then instead of the stock market. Yep.
But at the end of the day, if you're just because the appraiser says the value is only 250 or 275 or 350, it doesn't mean you have to realize any of that loss. It's just that today, if you were to sell it, you would experience that loss. So just do like my kids do when it comes to chores and just put it off till tomorrow. It'll come back.
That's a funny analogy. The matchsticks. I don't think I've ever heard that one before, so I appreciate that one. You mentioned in the past, we've talked and I've heard you speak about LIHTC, low income housing. Is that part of your strategy? Is that something you recommend when it comes to someone who may be starting new, or is that something you want to stay away from because of all the rules and regulations?
Well, the reality is if you look at low income tax credit housing, which is the acronym is LIHTC, you find that that you have to work with an experienced developer of the LIHTC project. And so we have a particular, and nobody wanted to do LIHTC when interest rates were 3%, right? Mm-hmm. But a LIHTC project, the government issues you tax credits to cut your rent, right? So if the market rent in the area is $2,000 and you agreed to work with the government for, $1,100, they're going to issue you tax credits to make up that loss for you. Then you turn around and you sell those tax credits, and it gives you capital for your project that you don't have to repay, right? So when you're looking at a 3% loan, LIHTC doesn't make a lot of sense. Right. But when we're seeing 9 and 10% capital out there right now, it makes a lot of sense because you're able to sell those tax credits, get that capital, borrow less from the bank, and capitalize your project. You're also going to be working with a experienced HUD LIHTC developer that's going to provide a lot to your resume. And then you're not necessarily the one managing the paperwork, he is. And so there's a time and the place to understand where LIHTC can fit in your capital stack and help enhance your capital structure. And knowing that will definitely let you know whether or not that's a good deal or not.
Got it. It's an interesting concept because I haven't been introduced to LIHTC housing at all. And it's something that, again, it's different because your standard deal of buying to rent and renting to hold on, then holding on to sell is the standard practice that everybody gets into because it's comfortable. I mean, it's an easier practice when you know that you're just buying, you're renting it out, the rent is going to cover the mortgage, you're going to sit on the property for X number of years, and ultimately, hopefully, you're either going to refinance it to find another down payment for the next property, or you're just eventually going to sell it, and there you've got your income. Do you deploy strategies for flips at all, or do you generally recommend, especially, in the industry, in the industrial space, do they do flips in industrial where you're buying, and then flipping it out and after you've done some renovation, or is that something that's kind of you stay away from?
I've done flips in the industrial space. I wouldn't recommend it. But, it's not as prevalent in the industrial space as it is the multifamily space. But here's the other thing. It's much harder to do a flip in residential or commercial in a normal market, right? I mean, when you're really thinking about it, you're buying a $300,000 house, you're putting $100,000 into a remodel, and you're trying to sell it for $500,000 and make 100, right?
Right.
But if you look at it, then you're going to pay ordinary income tax on that. So now you're going to pay 37% income tax on that. Whereas if you just bought it, held it, maybe did the BRRRR strategy on it where you refinance it, get some of your money back. Maybe that's now a 3 to 5 year window, but you still own the asset in 5 years. I got to tell you this, Daniel, I've been doing this for 25 years and there has never, ever, ever been a time in my life when I've been happy 10 years after I sold the asset.
Really?
Not once.
Why is
I
that?
always wish I still had the asset.
Because it would have
Now,
appreciated.
I
more
did
10
need the
years from
money,
now.
right?
Yeah.
I did need the money. It looked like a good idea at the time. And I've made a lot of money with the money that I got from the asset. But if I still had the asset from 2001, the very first one I did on the industrial side, I sold that for $400,000. That building right now is worth $1 million. So here I would be 20 years later with $1 million asset. I would have refinanced out a couple of times. I would have harvested my cash. I would have had cash flow. But instead, I took my $100,000 profit and went and did something else with it. Now, I could make the argument, maybe I made more money, maybe I didn't, but I would rather just have the argument be very simple and go, can I go back in time and keep the asset?
Fair enough. Fair enough. It makes sense. I mean, so a 1031 exchange. I mean, that's something that I've thought about. I mean, taking a 1031 exchange, and I know the rules when it comes to residential. Are they the same when it comes to industrial as well? And if so, how often are you doing a 1031 exchange? And it's something that's easy to do?
Everybody talks about 1031 exchange, and that's really one of 3 strategies that you can use in the real estate world. One, I mean, the 1031 exchange, if your listeners don't know, it's the selling of one property and buying another property for $1 more than this property within a set period of time that allows you to defer the gain, right? Now, my brother, he likes to pay taxes now because he's a firm believer that taxes are never going to go down in percentage. And he's probably right. So when he sells something, he pays the taxes now because he doesn't want to owe a bigger tax bill, a higher percentage later on down the road. Now, I know we'd like to believe that Congress is actually hard at work reducing our taxes, but we know the contrary shows up in our paycheck every time, right?
Right.
But at the end of the day, you can do a 1031, you can do a deferred sales trust, or you can do an investment into an opportunity zone, right? So there are different ways to do that. When we exit a deal, we always make sure that we talk with our investors. We work hard to make sure that their exit is as tax-free as they want it to be. So if they want to get to a place where they're paying no taxes, they're deferring the full amount, we can help them with that. If there's other strategies that they want to do, we can help them with that so that they can get to the lowest tax bracket they possibly can based on what they want to do as they exit. Because I think that it's my responsibility as a syndicator, as a lead on these projects, not only think about how we get in the deal, but think about how we exit the deal and how that affects them in their net keepable profits. And so we always like to make sure that we walk through that, we talk through that, our investors know what their options are, and we do everything we can to make that as tax-free as possible.
And these are conversations you have with your investors before they get into the deal, or is this, at the time of exiting, you start to talk about it and kind of work through this with your investors?
Well, investments are like marriages. You always want to have the conversations before, right? Because if you don't, it'll cost you half your stuff. But, in California, it'll cost you 61%, right?
There you go.
But the reality is we always want to talk with the investors before. Where is this capital coming from? What are your goals with it? What are your plans for it? So that we don't put someone into an investment. We're not a one size fits all kind of a cram it in group, right? Right before I got on this podcast, I was talking with a new investor and his primary focus was taxes. He wanted to pay as little tax as possible right now because he is still employed and he's wanting to eliminate his taxes, grow his wealth, and cash flow was a secondary consideration. So we want to put him in assets and investments that fit that. And we always have several of everything. So we were able to direct him to the asset that would maximize his investment plan. And I think, Daniel, if I see one common problem with investors, whether it's residential, whether it's industrial, whether it's been doing it for 2 years or been doing it for 20, is they don't think about what is their investment thesis. And what I mean by that is, why is Daniel investing? Are you investing because you have you're a doctor and you're making $500,000 a year and you need to figure out how to offset some of that taxes, and 20 years from now, you're looking for cash flow? Or are you somebody that's 70 years old that has a set amount of money that just wants to get paid every month? Or are you someone that has a little bit of money and you really need it to grow, so you're looking for appreciation plays like development? So we start with those conversations because we want to ensure that they have everything they need to make the right choice for what their mind is saying they want to do for investing. Because the worst thing you can do is put somebody that wants appreciation into a cash flow deal because they're getting a 17% return with a 6% cash on cash instead of a 30% return that they really need. I mean, I hear this all the time. I really want cash flow, but you only have $100,000. What are you going to do with $6,000 additional each year?
Right, right. Whereas if you take that $100,000 and you invest it in something that's going to appreciate 10, 15 years from now, that 100,000 will grow into something more than the 6,000 return on investment.
Correct.
Yeah.
Our development deals usually do in the mid 30s, right? And so if you're into that deal for 3 years, you're walking in with 100, you're walking out with 2. 7 years later, you've got 4. 10 years into the journey, or 11 years into the journey, you've got 8. Now you can start talking about cash flow because the 6% cash on cash return on $800,000 is 48 grand. There's a big difference between those two scenarios.
I understand it, and it makes really a lot of sense when you explain it in the example that you just did. So my next question then, Shannon, becomes, well, when do I know I'm ready to invest like this? When do I know I have enough cash? How much am I looking for? And am I looking for, to start this as soon as possible? Or am I saying, no, let me build, other assets around this so that I have backup, or do I just jump into this as soon as possible?
Well, the reality is at the end of the day, you have to be in a place where what you're looking to invest, you're comfortable without, right?
Like any other investment, right? Any investment, you have to make sure that you've got the income coming in, right?
I mean, if you need that $5,000 because the transmission went out in your car, then that's not a good time to, you don't have money to invest. What you need is to have money that you can set aside for 3 to 5 years that might turn into 7 to 9 years, and it doesn't change your life, right? But when you look at what you're to invest, I would recommend that you get to a place where you have at least $50,000, because most deals, unless you're going to do the single family on your own route, and then when you have the down payment and 6 months of reserves, then you're ready to invest. But everybody's different. I have people that are very comfortable betting all of it all the time. And I have people that are only interested in betting 10% of it at any time, right?
Mm-hmm.
And so it really comes down to you, but then you have to ensure that you're educated. And then if you're going to go into the syndication workspace, you need to make sure that you understand and have underwritten the syndicator. A lot of people forget that step and they completely focus on this great apartment complex in Memphis, but they fail to look at the fact that this is maybe the first deal for this operator, or maybe it's the third one they've done since they got out of prison. And, so you just need to make sure that you understand who you're working with, right?
They got caught on the other deal, which
Exactly. I mean, I wasn't going to say that, Daniel, but yes, you're very observant.
We could be a little blunt about it. I appreciate that.
Not that would happen. If they went to jail, as well as I do, they'd go to Congress.
Yeah, then we've got other problems. But no, I mean, it's a very, very valid point. Who you get into business with when you're giving them $50,000 or $100,000 it is very important. I mean, it's important to vet out. So are there questions or maybe conversations that I, as a potential investor, would want to ask when going to a syndicate?
Yeah, absolutely. The first one is track record, right? How many deals have you done? How long have you been in the business, right? And I'm not saying this just because I've been in the business for 25 years, but you're wanting to know, have you handled other markets than the one we're currently in? Because the one thing that we know is life and real estate will change. And if you haven't dealt with other cycles in the market, you're learning for the first time. And I don't know that I want you learning with my money.
True, very true. I'm not going to be a guinea pig.
Yeah. So if you've been investing in real estate since 2012, you've seen a very slow moving market. You've seen interest rates go down. You've seen interest rates go up. You've seen interest rates that were about 6.5%, I believe, in 2012. So you've seen the kind of market that we're working with. You've managed and you've owned in a normal market. And then when it got super spicy in 19 and 20 and 21, you saw how to take advantage of that. So you've seen a couple of different cycles, and now we're going back into prices are constricting. Everybody's saying, oh, it's just like '08. I was there in '08, and this is nothing like '08, right? We are seeing rents decrease. We are seeing pricing decrease. We are seeing cap rates rise, but we're seeing all of those do things back to a normal level, right? I mean, how many years did you think we could sustain 10% rent growth?
No, it's not. It's not. I mean, at some point, it's got to crash.
2% and 10%, that's 12%. That's 6% annually. That's more than you should have in your pro forma, right? And so when you look at how all this comes together, it's very logical, but these are the kind of questions you need to ask. How long have you been doing this? How much capital do you manage? I always like this one. What projects have you had fail? And if they say none, hang up.
They're lying. Either they haven't been in the business long enough or they're lying to you.
And the reality is, you mentioned my quote about making it more intelligent investors. I want everybody to understand you are going to hit it off the side of the bat once in a while. You're going to find a deal that's not going to work. And it's how do you recover from that tells me everything about who you are. If you just throw up your hands and go, well, that didn't work, let the bank have it back. That's not a great idea. But when you're looking at how do I make this work? What can I do long-term to change this? How can I work something out with the bank? How can I change the trajectory of this before I just throw up my hands and walk away?
Fair enough.
Are there any bad deals you could tell us about? Are there any deals that have gone south that you have been able to recover from, let's say?
Oh, well, yeah. I mean, one of the very first deals that I did was I was driving down the road and I saw this big sign. This was back in 94, right?
Okay.
Big sign painted on plywood, house, $5,000, right? So I had to stop and I had to look. And it was a house that was built in 1921. And they were selling it for $5,000, but you had to move it, right? And I thought, well, dang, a $5,000 house, what a deal. So I went down the street, I bought another lot for $30,000. So now I'm into this $35,000, but I have to move the house.
Which will cost you more too.
Which cost me another $12,000.
Okay.
And then I had to remodel the house. And it had a little root cellar on it, but when I moved it, I put a full basement on it. Daniel, 9 months later, I sold the house and I made $11,000. So I worked on the house for 9 months for $11,000. That was not a great deal. So it was an old house. I did all the work. I put in all the time, all the effort, and I made 11 grand. So I made less than minimum wage. I should have sued myself for underpaying myself, right?
Only if that was allowed.
Right, exactly, right? I was going to turn myself into the labor board, but then I'd have to show up and run back and forth and, defend myself from
Your Honor, I plead, or go back and forth as the plaintiff and defendant.
Going, and I built my way out of it, but I made such a little amount of money, and I learned a couple of things. One, don't buy houses for $5,000. Number two, don't do things that are not in your skill set.
Mm,
There are
I like
people that
that
love
one.
remodeling. I would rather go play in the freeway, right? Because I hate remodeling. I like doing new construction. I like doing value add, but a full ground up remodel where you're putting in a new pump station for the sewer and you're putting in new bathrooms downstairs and you're tying them into old bathrooms upstairs and you're dealing with a 1920 house. It's just, there's a lot of things there that I learned. However, the biggest thing that you need to learn in real estate is getting the deal done gives you all the credit and all of the understanding as to whether or not you want to do it again. And if you want to do it again, great. Now you can make a business out of it. If you don't, finish the project and move on.
Say that one more time. Getting the deal done gives you all the credit so that you know if you want to do it again.
Yeah. I mean, there's not one aspect of real estate construction or development that I haven't done.
Right.
There's a lot of them that I won't do again.
Now it makes sense. I get it. If it's good for you, do it again. If it wasn't, stop doing it. It's the simple thing that I've been trying to take that and implement it into my day-to-day for life and try to learn from that. That's awesome. Shannon, we're coming close to the end of this podcast. Any final words for people who are wanting to take the plunge and wanting to get into this, but are hesitant just because they haven't found the right person to start to work with?
Well, the reality is at some point you have to get done with the analysis paralysis and you just need to go do the deal. And again, I would tell you to find someone that is doing what you are doing. Everybody says, I see a lot of people that say, well, I want to be a GP. I want to be a general partner. I want to be the big dog. Well, how do you know what a dog looks like? How do you know how this deal works, right? So I would encourage a lot of people, if you're hesitant about real estate and you want to do it, find someone that's successful at it and invest with them. Because then you're able to see how they do it. You're able to walk through the process with them. You're able to see all the things that they do right, all the things that they do wrong. Maybe you agree with them, maybe you don't, but it gives you a basis to then decide what you want to do from there. Do you like short-term rentals? Go talk to people that are doing them. Get involved with them from an investment standpoint. You want to do hotel conversions? Do that. You want to do ground up? Do that. But make that as an investment step rather than a full-time commitment.
Interesting. Good advice. Well, Shannon, again, so if somebody wanted to connect with you and this inspired them to come and connect with you, Shannon Robnett Industries, what's the best way for someone to get in touch with you?
It's really easy. And I had to make it easy, Daniel, because I'm a contractor, right? So it's
Right.
shannonrobnett.com. It's really simple. If I can't remember that, I'm in big trouble.
2 N's and Robnett.
Yep, shannonrobnett.com. We've got our past deals on there. We've got some education on there. There's a link to my podcast. There's even a link to my calendar if you want to schedule 15 minutes with me to figure out what your next steps can be. It's all right there, and it's all in one place. Also, all of our social media handles are there, so you can follow us from there.
Awesome. We're also going to put links in the videos below, and obviously share all of your social media platforms as we share the posts. Really, Shannon, thank you so much. I really appreciate your time. It has been an absolute blast speaking to you, and hopefully, we'll catch you again in a couple of years when you've gone from 350 million to 500, if not 700 million, closer to the $1 billion mark.
Well, thank you, Daniel, for everything you do, putting out this podcast for your listeners. I know that it creates a valuable resource and people should be taking full advantage of it.
Thank you so much. Guys, thank you for joining, and we'll catch you on the next one.